Well, good morning, everyone. It's time for Macro Monday. Bitcoin crashes over the weekend, and we are trading exactly where we were a week ago when Mike, James, and I talked last. What's going to happen next? Well, let's have the conversation. Scott's out today, so it's just the three of us, which means I'm going to try to talk less, and let's get going.
Let's go.
Well, it's Macro Monday time, and as I said, we're trading exactly where we were a week ago, which is kind of funny if you look at it. But here we had a nice little crash over the weekend. But before we talk about the crash, and I let James talk about leverage, why don't we see what the hell's going on in the rest of the world, Mike? So what was going on in the morning meeting this morning?
Yes, thank you. Dave will go there, and I encourage everybody to listen to the interview with James and Scott this week, and it was quite good. I really enjoyed it. So starting with Anna Wong, talking about Kevin Hassett, I guess he's 70% in Polymarket. She does think he will be the next Fed governor. What she thinks will happen is he'll probably start influencing the Fed and the market starting in January. Mr. Moran's seat will be up. He thinks Hassett will initially take that seat and then move into the chairmanship once he's officially designated and approved and everything. She did do an interview, Anna, with Kevin Hassett a couple weeks ago. And she said Hassett is expecting investment and productivity boom in coming years, similar to what Mr. Greenspan nailed in the 90s. And kind of key things that he's looking for signals that Greenspan was able to nail. And one of those was declining prices of telecommunication goods. So she thinks Hassett's going to be a push for a dovish view and management reform at the Fed, maybe, focusing on why they missed the transitory a couple years ago. Politically, obviously, he's a bit leaning left, or the Fed's a little bit leaning left. Hassett will offset that. And then she focused, there was a question about Black Friday. MasterCard spending is about 2%, 2.3% real growth this year compared to 3.5% last year real growth in Black Friday. Ira Jersey, our income strategists, pointed out that funding markets bounce contract for month end to continue. There's a bit of a excess. The Fed does not have excess reserves that we've done in the past, but he thinks the long end's still going to remain range bound. The short end to rally more, so he's still looking for that bullish steepener, but thinks the Fed's going to be more dovish than the market expects. Michael Casper, our equity strategist, pointed out all the good things are happening in the stock market. Earnings are running 14.9%, 95% strong this year. Industrial sector is the only one that's missing, getting a lot of participation outside of Mag 7. The other 493 earnings are running around 11%. Typical signals are still green, but less bright than last quarter, and average 13% earning per share rise expected in 2026. It's the high since 2018, so his quote was that could bring in a little bit of volatility. Small cap earnings still strong. Audrey Child-Freeman pointed out dollar starting the month week and expects that's pretty much on the back of the dovish Fed, which is now priced 100% for a cut next week, on the 10th. Sorry, that's not next week. More dollar weakness expects into 2026. Strong, and she pointed out there's a strong negative seasonal factor in the dollar in December. 8 of the last 10 years was down this month. And then I pointed out, I've been focusing on that Bitcoin to gold ratio as one of my key lead indicators. It's broken down. 25 was the key support. Now it's at 20. It's the next support. Fair value is around 13. And I just pointed out why I'm really, really frightened about the things I see in the stock market. I'm sorry, in the commodity market, and that is gold. The velocity of the rally this year in gold is only happening once or like 3 times or so in the last 50 years, but it's never happened with stock market volatility getting buried like this. So it might be an indication that Bitcoin's going to be right, and it's going to pull stock market down with it and volatility back up. So to me, that's the key thing I point out. And then I point out crude oil still think the trend's downward. With the grains, and markets are waiting for pops to sell. And right now it's the time to be light on positioning, and you wait for rally to sell into bear markets. Back to you.
Yeah, I mean, before I say anything, because we'll let as moderator, as I promised last week, I tend to want to talk a little bit less. I will say one thing. I still think that gold is going to run to 5,000. I've said that on this show multiple times. I think that the liquidity, gold is unhindered by some of the idiosyncratic things we're seeing in Bitcoin, and that's what's going on. It's interesting that I think gold is going to lead the hard asset rally higher, and I think the hot money is there first, and we'll see it pause once we get to that level. Of course, there'll be a ton of euphoria. I mean, just the fact that what it did over the last week is I think pretty interesting. I mean, I assume you agree with that, James. I mean,
yeah,
everyone in the world on the trading side thought once it lost 4,000 a couple of weeks ago, it was going to stay there, and here we are back pushing towards the all-time high again.
Well, let's talk about just overall the macro picture. And Mike, thank you for your nod to my to the interview I had with Scott. We talked a lot about leverage and about liquidity. And so one of the things that you said is dollar strength. I mean, if you look overnight, you look at the overnight markets. We can't really talk today about macro without bringing up Japan, right? So one of the key structural changes that we're seeing in Japan is that they're allowing the 10-year to the Japanese 10-year is now trading at 1.87% yield, which is remarkable. It's a remarkable move for Japan. If you look over the course of the last decade, Japan's 10-year has gone from about 30 basis points down to basically negative 30 basis points. And now it's up to 1.87%. What does that mean? What does that mean for the macro world? It means that the structural availability of free capital in the world is gone. It's over. So, and this is what we talked about either last week or a couple of weeks ago, I think, Mike, is that the era of borrowing from Japan for nothing is over. And so part of what you said today is, and what came out in the meeting is the expectation of a stronger dollar. Well, I'm sorry, of a weaker dollar. And part of that is that you're seeing today that the Japanese 10-year yield up means that the yen is stronger, meaning that the dollar is weaker, because one of the key components of measuring the DXY is the yen. And so that is happening right now. So now we kind of roll into what you're talking about, Dave, is, gold and Bitcoin and all the indicators of what's going on in the macro world. Well, I agree with you. I think that gold structurally is going to go higher from here. I think that because I believe that we're going to continue to see liquidity. It's just not going to come out of Japan. And so it's going to be coming out of central banks. Primarily, the big central bank that we're going to see come out of is the U.S. central bank. And it has to, because it has to support the Treasury. And when that happens, how that happens, I think that, some of the faster money got ahead of itself. And you're seeing that in overnight prices of Bitcoin. This is nothing new. We have an end of the month here. It's, now December 1st. So the last day of the month was yesterday. And I think that we had some algorithms that were triggered both month end and just price wise and risk off sentiment because of what's going on in Japan. And I want to make it clear. I don't think that carry trade is blowing up. I don't think that we have an implosion somewhere. That's not what I'm seeing. But you are seeing a structural move toward or away from free money. And that means that you've got to reprice risk. And when risk is repriced over the weekend, what gets repriced first? Of course, Bitcoin does. It trades 24/7. It's going to get repriced. Now, here's where it gets interesting. And here's what I'll bring up a chart here. And we can look at this, Dave, if you know how to do this.
Well, I just tried to, yeah. Okay. So hold on.
So
okay,
if
good.
you can,
I see it.
you see my,
I saw your chart. Nope, that was a different one.
There it is. Okay. Well, this is the 10-year, the Japanese 10-year. And so you could see it's just structurally moving higher. And this is from 2020, when they were keeping it at basically zero ZIRP, zero interest rate, policy. that this all kind of came undone. We all talked about this, and we've seen this movie here in the yen, but this is a long-term move. This is not like a violent move upwards. This feels violent, but you can see the policy changed. Okay, that's the 10-year. The policy has changed. So that's one thing. And then if we go to Bitcoin and we look at the liquidations for the last 48 hours, you can see that the liquidations came, and let me make this bigger for everybody. You can see the liquidations came here when we were in the 90s. You started seeing shorts being liquidated, and then this risk off sentiment occurred, and boom, we just hit a cascade of liquidity, you know, and this is the cascade of leverage unwinds, and it just continued and continued, and then it kind of held its value right into early into this morning, and then it hit it again for another washout here. And these bars are leverage. That's all this is. Was it a massive amount of leverage? No, I think it was about $700 million from what I've read. Dave, you probably have a better handle on
very,
that.
very thin. It almost, because of October 10th, he doesn't even show on the liquidation chart. The fascinating part about this is one would think that the amount of Bitcoin that is bought by yen carry trade is tiny. One would think that the yen carry trade unwinding off of the BOJ news that Bitcoin reacts to, we would come in and we would see very different markets this week.
Let's talk about that. So really what I think is happening here in Bitcoin is that you've got leveraged longs expecting movement from the Fed a little bit too soon. Okay, so what is significant about today? Today, QT is ending in for the Fed, right, in December. I don't know if it's December 1st, December 5th, whatever. They said December. So if QT is ending today, okay, that's significant enough. It's $25 billion of liquidity. It's not going to be drawn out of the markets, but it's not liquidity coming in yet. Now, we did hear Powell say, and he's reiterated, and other officials from the Fed have reiterated that we are going to see liquidity come in from the Fed for bank reserves. But that does not mean QE in the traditional sense. It could just mean that we're seeing a steady flow, a steady stream of liquidity in the short end of the curve to just shore up bank balances. And that means Treasuries buying T-bills with the expectation that they'll roll off pretty quickly. Now, we've seen this movie before also. Back in 2019, we saw the repo crisis where the Fed came in and said, this is not QE. It's not QE. So it became the term of QE, not QE, right? Or not QE, QE. And so because it never rolled off. And so essentially it is liquidity, but it's not the fire hose that we saw back in 2008 or 2010. And again, in 2021, 2022, it's not the same fire hose. But the significance of it is the era of tightening is over at the Fed. We're not tightening anymore. That's it. Now the question is how much liquidity is going to come and when. And I think that the markets got ahead of themselves once again in crypto and Bitcoin. They got ahead of themselves thinking, okay, well, QT is over. Here come the fire hoses. No, it's not quite that simple. And so we really need to zoom out when you're investing in assets that are being adopted like this. You have to zoom out. So to your point about gold, Dave, I think you're right. I think that gold is going to structurally move higher, but it's going to move higher along with liquidity, and that liquidity is not going to come in a burst or a cannon or a bazooka today. If it does, it means we have some sort of black swan event. We're going to see a lot lower values in all these markets, a la Mike McGlone's points of a steep drawdown. Yeah, we would see that, and everything will correlate to one, and then you'd have the fire hose. But what we saw last night is the realization and the algorithmic trades and response to the reality that Japan is letting this go a little bit. And they're doing it again. It doesn't look like it doesn't look like there's chaos in the markets. Okay.
No, that was actually going to be my
And
point. I
it's
wanted to
just,
ask
it
Mike
looks
about
like it's a
that.
structural move, and they're trying to do this without having a drop from, you know, a 10th floor, 10th story floor to the ground. They're trying to take an elevator down and kind of stop in between floors a little bit rather than just drop it off a cliff. And so that's what I think we're seeing. And I have not heard of any desks being blown up from this yen carry trade yet, but I do see a risk off sentiment. And again, this is a mathematical end of month, end of year risk off sentiment that you're seeing. And that's kind of what, from my perspective, I would love to hear Mike's views on this, but that's kind of what I'm seeing from where I'm sitting. And Dave, anything you're seeing, and just the sheer amount of leverage that came out.
Well, it wasn't that much leverage. That's the
Right.
strange thing. It was less than $1 billion. I mean, you know, as I said, I think, you know, Mike, you and I all agree on, well, we don't all agree on a lot of things, but one thing we do agree on is Bitcoin does tend, because especially on the weekend, tend to be a leading edge of the spear, unless, of course, it was complete nonsense. And it doesn't take that much to move the Bitcoin market, right? I mean, we saw less than $1 billion in liquidations.
Well,
I mean,
when you
how
have
much-
leverage like that, it doesn't. It's just
Right,
sitting
so-
there. It's just sitting ducks, just ready to be picked off.
Right. And so, you know, over the weekend, right before that happened, you know, whatever, James Wynn famously said, okay, I'm not short anymore. Whatever, and stay tuned. And, you know, you have all these people who are like, oh, okay, that's probably, and who knows? I mean, maybe many of his followers just went and said, oh, if he's not short, let's go leverage long and see this thing go crazy in December. And then, of course, they're easy sitting ducks to get picked off. The thing that's interesting is if you look, I mean, Mike, I'm sure your bond strategist has said this. You just look at the 10 years; they pretty much all moved in lockstep. Germany, I mean, everything is 5, 6, 7 basis points among all of them, and that's not, you know, that doesn't look like, you know, the headline saying Bitcoin dropped because of the BOJ. Well, then why would bond yields have all kind of moved, you know, fairly muted, pretty much in tandem? I mean, everywhere else other than Bitcoin, there's no sense that there's an issue in the yen carry trade, because the yen carry trade is a very big deal in the bond market, right?
Look, we had the yen carry trade blow up in August of 2024, right?
Mhm.
We experienced it. It was a lot of fun, and but that put everybody on alert, and that was kind of it. And so I just don't see these desks being way over their ski tips on this anymore. It just makes no sense to me. And
Now, there might be some hedge funds, but there won't be any. We're not talking about any professional dealer desks, the ones that are the systemic.
exactly. So exactly.
Right. Anything on that, Mike? What are you thinking?
Yeah, I'm glad you went there. I agree with it. And if I can just run through some screens and kind of mimic on it. Obviously, my bias is the big one. This is way overdue. And yes, I've been wrong on that one for a while. But here's just, you pointed out global world bond yields. They're all up about 6 to 7 basis points, with the exception of China, which is not really a live market anymore. It's very closed. But yeah, they're all up. Europe, Japan's up 6 basis points, US up about 7. But I want to tilt over to, I think, what's really going to be mattering and why I'm sticking with this bearish view is, first of all, this is just, you take Bitcoin divided by its 50-week moving average. It's, you know, it's at right now at a 15% discount. It's never, ever gone down below its 50-week moving average this time of year, certainly without S&P 500 following. This is since 2017. To me, 2017 was the milestone because that's when futures started trading. And then the next milestone was when we had widely disseminated ETFs, which was really 2024. So the key questions for the end of the year is, will Bitcoin be the Grinch? And then I like to point out, yeah, I think so. And one of the key things that really tilted me, I just want to show you real quick, tilted me lower to get to give up on a little bit Bitcoin too much last year, was if you look at it versus 50-week moving average, it's made the same lows and lower highs. It's a maturing bull market that's becoming normalized. But the lows have been the same, around a 50% discount. I expect that. But you overlay that with what's happening with gold. Gold is rising versus this 50-month moving average. Bitcoin declining. So from a leverage standpoint, which is my background, everything's leverage. You want to belong to one that's increasing relatively, and that's a big difference. But also, I want to show you out to me my favorite leading indicators. Bitcoin to gold has broken down. 25 was the key support we looked at all year. Now it's at 20. Our model says it should be closer to 13. And the bottom line for everything, what you talk about, is why there's not a lot going on and a lot of, it's just kind of a complacent market. Is volatility. S&P 500 is buried. It's kind of potentially recovering. This is 120-day volatility, potentially recovering from the lowest level since 2021, 2020. And we end the year here, it's the lowest since 2017. So I'll just end with one thing that I'm still worried about. Here's volatility, very buried. Last 5 years, Bitcoin's inflection point has been around 50,000. When people say, look at the chart, it's bullish. And I say, okay, well, that's normal. And that's why I'm worried for going into the end of the year, the Grinch might be coming in here. And if we just get a little more trickle down, especially with bond yield spiking here, this is not good for any risk assets.
Yeah, and look, and we talked a lot about this with Scott, and I talked a lot about this, which is, Bitcoin liquidity cycles, Bitcoin 4-year cycle, its historical performance, and looking at it, there's only a few data points, and to me, as a long-term investor, that just means that you're looking at something that just does not have enough historical data to really give you comfort and confidence in trading it. Now that said, because of these cycles, there is some self-fulfilling prophecy. There's no doubt about it. But the reality is that I just think that the 4-year cycle for Bitcoin is over, and we are in now this is showing you, especially in a day like today, it's showing you that it is the tip of the liquidity spear. And so it is showing you what markets expect from liquidity and are reacting to in liquidity in kind of a hyper reactive mode. And so unfortunately, you have to zoom way out to really understand how this is working with Bitcoin, because it does have short-term volatility. But that means that something like gold is, that's also reacting to liquidity. And that's why I don't think that gold is finished. And I think that gold is going to structurally move higher. So, and I believe that, Mike, because just like the market, it on all metrics, forget about Bitcoin, just look at all the market metrics, it looks overdone, unless of course you change the denominator. It doesn't look quite as overdone as it is, but it still is overdone. It's super concentrated. You have a tremendous amount of risk in just a handful of names that are hinging on this AI, new structural change to not just the market, the economy. And so, when is that, like, is that going to is it going to take a breather, and how much of a breather is it going to take? And does that cause a cascade of selling where the Fed has to rush in and dump liquidity into the markets rapidly? That's really the big question. It's not the question about whether or not we can have a breather. Well, of course we can. And we all agree that this, the danger is that it's extremely concentrated, and it has gotten ahead of itself. So, but to look at Bitcoin, I think that you really do have to, I mean, I know Bitcoins love saying the zoom out, zoom out, zoom out, but you really do have to just pull back. You do have to zoom out, and you have to revisit what your thesis is. If your thesis is that Bitcoin is the hardest money in the world, that it cannot be corrupted by central banks, it cannot be corrupted by the dollar or the yen or the euro systems, that it will swallow them because of exactly what we're talking about, and that it can't be just expanded on and devalued and debased like the other currencies, then that's your thesis. And you have to zoom out and really understand that, hey, look, this is a volatile asset that's going to continue to be volatile along its long-term adoption, kind of personality. But as something you look in in the markets. But to just trade it around on 4-year cycles, I think at this point is probably a mistake. We have to see how the liquidity cycle is playing out. Are we finished? I don't think we're finished yet. I think that we're entering a period where the Treasury is going to do whatever it can with a government that and an administration that is likely leaning heavily toward liquidity rather than pulling liquidity, especially as we go into midterm. So this does turn political. And now you've got a Fed that we're going to see a regime change in that is going to change to a regime that is probably highly favorable for the current administration. And when you have that with an administration that is hammering for lower rates, hammering for liquidity, well, you're probably going to see that next year. But again, we're still in December here. Midterms aren't until almost a year from now. And so there's time for all of this to still oscillate around and play with. And so I do reiterate, if you do have a long-term view on Bitcoin, don't forget it. Like, step back, take a breath, take a moment. It doesn't mean that you shouldn't have liquidity sitting there waiting opportunistically for a trade that Mike is pointing out that you could have a drawdown. That doesn't mean that you should be 120% in on it. I think that Mike would tell you, take chips off the table and step back and be ready for liquidity. Now, in my hedge fund, we're ready for liquidity because we have different levers we can pull than an individual can. That's a completely different thing. But, it really is, it's determined by your own balance sheet and how you're approaching this. And so I cannot reiterate this again enough. I reiterate the caution around having leverage on something like Bitcoin. It is still violently volatile, and you've got to be aware of that. So, last night again is another warning.
Really important. Look, I personally think that this was idiosyncratic, and that people there's a tweet that I did last week, or a post that I made last week, where I lamented how in the long run the narrative does tend to fit price, right? Price and narratives do work, right? So the long run narrative, why is gold up? Gold's up because we print more dollars. The denominator changes, gold price goes up. Full stop. End of story. It works.
First principles.
That doesn't mean anything different. In the short run, when there are short-term price moves, people always desperately, it's sort of like the search for religion, search for a reason. What happened over the weekend? Well, the answer over the weekend is somebody, and it could very well have been orchestrated, looked at what was going on. And you made the point, you said words that were important words that I want to delve into. You said picked off. And what happens is traders like to make money, and big traders have big bats and can do things. So if, for example, you have a position where you are long spot Bitcoin on exchanges, you are short perpetual swaps. And by the way, in the funding rates, you can see that trade is not nearly as expensive as it would. That trade is not nearly as good from a funding perspective as normal, right? But it has oscillated. We went from negative funding rates to now slightly positive, but still below normal. So that trade costs you a little bit.
Walk through what that means for people who don't understand it, because
right. So when the funding
really
rate
confusing for people,
right? So when the funding rate is normal, effectively what that means is you're being paid to be, you're being paid to be long, you're being paid to be short on the futures or on the perpetual swaps, slightly enough to offset the cost of the money you borrow to do that. And so, and when the funding rate is negative, you're actually being paid, to be long, and so, or paid to be short. And so when it oscillates back and forth, trading desks, and there are trading desks that do this all day long, they use it. They either have long or short spot positions that they've borrowed vis-a-vis perp positions where they can make money. Now, it obviously costs to borrow spot, not nearly as much as it used to, but it still costs. So what happens is traders look at this and their opportunity cost is what they care about. Because if you have a big position that's hedged, the only reason you would have that big position is, well, to be quite frankly, it's you're moving in and out of it. If you're going to hold that position, unless you're being paid to hold it, i.e. funding rates are high, you wouldn't hold it. But you could build it up and then dump spot at an opportune time. What is the most opportune time to dump spot? On the weekend. When on the weekend is the most opportune time to dump spot? Generally, it's Saturday night. Well, what happened? So, if you're asking me probabilities, the probability is a trading firm or firms wouldn't have taken more than one because it wasn't that big of a move, saw an opportunity to have a large spot position and dump it at the same time that they were hedged in the perp markets, and they take their profits at the bottom of the dump. Because the spot, what you do is, and this is true about every electronic book, but really true in Bitcoin and really true in crypto, and particularly on the weekend, is liquidity is concentrated right at the bid offer. And if you look, liquidity down $5,000 on Bitcoin, it gets less and less. The first $1,000 move in Bitcoin may cost 300, 400 million. The next might be 100 million. The next might be 50 million. The next might be 20 million, right? Until people start reacting and putting bids back in the system. And so it always tends to be sized as a move in sizes that make sense to people. And so you look at it, and this looks like, I hate to say it with a word, they would call this in if it were in a regulated market that was US only, it would be called manipulation, and someone would be getting investigated for it. Now, in the crypto world, there are no regulations in terms of market manipulation, except the CFTC literally does have authority. And whether they'll ever do this, I don't know. But this is the sort of thing that is manipulative. You look at it and you see it. And it, to me, looks like that again. And we've seen this many times. I've commented. I'll never forget the 29,000 to 26,000 drop, which was $3,000. It's half the size of this, but it was from a significantly lower level. So in percentage terms, it was even bigger. We've seen these many, many times. And so we all rush to come up with narratives. Why did it drop? Tip of the spear, liquidity, all this stuff. Great. Except for nothing else moved, which tells me this was manipulation. Yes, someone may have looked at a news story that panicked a couple of people. Boom, down it goes. Now they look and here we are again. And that's why I made the observation that we're literally trading where we were trading a week ago on this show, having recovered a little bit. And then there was a rally a few days later. I don't think that, I'm just not reading a whole lot into this move. I don't think that it really means a whole lot. It's just that simple. I don't think it matters. I hate to say it, but it matters to traders, but I don't think it matters within the scope. I think that if we came in and the S&P and the NASDAQ were crashing down this morning, as Mike said, the Grinch started on December 1st. If that happened, okay, that'd be different, right? But that's not what's happening. And so that's why I think sometimes people overreact. I think there are a couple of other stories that we should talk about, though. On the macro side, one that I really would love to get your opinion on. Mike likes to talk about MicroStrategy as being the tip of the spear, but I think it is worth noting something. And James, you're in the Bitcoin community, so I'd like to get your comment on this. 4-year cycle, I personally think we're going to play out very much like the 4-year cycle, and it is exceedingly bullish. And I'll expand on this narrative later. And the reason is because the main driver of the 4-year cycle used to be fear when the halving happened that mining would fall off a cliff and the network would have a problem. And then within 6 months or so of the network being stable, then it rallied to catch up. And I think that we are now in a period we are the most stretched, where mining is still doing extremely well. The network is still the price of Bitcoin is at an all-time low discount to the total overall hash rate. And I think that there's geopolitical reasons for that. There's lots of reasons for that. But to me, that's a buying opportunity. I've been saying that for a while. Doesn't mean it can't stay bad for a while. 3-4 more weeks, it could easily, could months even. But the truth is selling at these levels relative to the fundamentals of what's going on in the network is just not a really smart move when you zoom out. But there's a lot of infighting. I don't think we've ever seen more Bitcoin OG people yelling, "Oh man, BlackRock this and Fidelity that and Vanguard this," and talking about all the institutions and how it's corrupting the meaning, et cetera, et cetera. And so you're seeing all this stuff play out that's idiosyncratic to Bitcoin. But it is worth noting this weekend, and another reason for my thesis is on October 10th, Bitcoin was 1/3 of the liquidation, and it was not the biggest. This weekend, Bitcoin led the liquidations significantly. It was a Bitcoin led, and in fact, that mattered. So inside, there's a Bitcoin story going on here, and barring major dumping from people who are who would be literally hurting themselves to do it. I just don't see this price action being all that destructive. I think it's actually somewhat constructive if you understand and you look back on it. But we could be in a bad macro cycle, but we're not seeing it anywhere else. Right?
Yeah, can I follow up on the bad macro cycle to piggyback?
I was trying to trigger you, Mike. So
Yeah, I know you would, and I know our audience wants us to disagree, but I mostly agree. The thing is, I want to point out, as a year over year, Bitcoin's down 10%. That wasn't supposed to happen. That's just a 1-year basis to now. After Trump was elected, before he was obviously elected, it's definitely higher. But the key thing I want to point out is what's changed. Number one is what you said, James, is what the Trump administration wants by stacking the Fed. That end game is over. First of all, we've solidified the fact that I want to show you a quote from here that inflation is the number one issue in elections, and if you're the one behind the government creating in somewhat inflation, which is the Republicans right now, you're definitely in elections going to help. If you keep inflation up, help the Democrats win. That's what's shifted. If you want to stack the Fed and keep the stock market strong, great, you create net inflation. But for the 60% in this country, they're not so much involved in that, you're getting hurt. And one key thing that's changed, I want to show you, this is my colleague Andrew Silverman just published on Friday. The headline, it's not so much the first line of this story, is something I would have never dreamed of a year ago. Under the nation's first crypto billionaire in the Oval Office. And then he explains what's going to change. That's what shifted the whole world. I remember loving this space when he hated it, partly because he didn't get the fact that crypto dollars are investing in treasuries and didn't get that. And now he's not getting the fact that, by the way, inflation is the number one reason to lose in the elections. And he's trying to create more inflation. But good luck with that. It's how the things shift. And that's why I want to show you what's changed in markets is the end game. Now, again, I show you the same chart, Bitcoin below its 50-week moving average. It almost always bottoms at a 50% discount. It's nowhere near there. But what's changed is we have Fed funds in 1 year. They've been hovering at 3% for a few years now, just bouncing on 3%. A year from now, it's going to be 3%. And we're still not there. We're still running around 4%. But my point is, this is going to be below 3% a year from now. This is Fed fund futures in 1 year, and partly because Bitcoin's going to lead the way to, I think, at least a 50% drawdown versus its 50-week moving average. So what it's always done, maybe it's different this time.
Yeah,
that's why I pointed out is it's not working. I just want to fill it with one key thing that's shifted this year is I'm predicting, and the market's telling me we're overdue for the third negative year for the S&P 500 since 2008. Hopefully it's not going to be this year. That would be a crash. And that's what I just showed you. This is Bitcoin gold. And you see this massive green candle this year. By the end of the year, I've been thinking, yeah, it could come back a little bit, but it's very green now. But this candle, I think, is going to be red next year. So that's my point is we have to put up with and probably deal with. We're at the potential end game where we're overdue for what used to happen, a down year in the stock market. Bitcoin's front running it. MicroStrategy is ahead of the game. All the crypto alts are leading that, and now getting towards the end of the year. So my point is we can just have a little bit of pickup in volatility. It's all pointing that way into year end. It might just be a week that it takes to switch to flip the switch, like it took 1 day in cryptos, October 10th, to flip the switch.
Yeah. So part of that is I think part of your thesis is it's priced in. Part of it is that we've already seen the liquidity. I don't look, I agree with you. And I wrote all about this on my newsletter this weekend. The game is rigged against the little guy. And that's just reality. If you do not own assets in this country, you're going to be left behind. And it's not about whether or not the Fed and the central banks have learned their lesson. They are mathematically trapped. They must add liquidity, or we don't have money to buy the bonds that we're issuing to pay the debt that we're creating from the deficits that we refuse to give up. That's the issue. And there's no way to give up the deficits without structurally changing the beneficiaries. And so are you going to tell all of the Gen X and boomers that have already paid into Social Security that they're going to get a fraction of what they're already getting a fraction of what they paid in for? Are you going to tell them that they're not even going to get that? That would be pretty, that would probably be worse than allowing extra inflation on a voting perspective. That would be turning your back on what you have promised the pay-ins for all these years. You're going to turn your back on them and say, well, sorry, you're just not going to get Social Security. No, they're going to print money and make sure you get Social Security and your Medicare and your Medicaid. So the question is, how does it happen and how quickly does it happen? Not whether or not it does happen. They are mathematically trapped. They can't get out of this. We are in a debt spiral. It is as clear as day to everybody who studies debt. And Mike, you studied debt for a long time. You see how it is. I just don't think that there's any way, and it's not that I don't think, you're looking at the numbers. If you have a way that you think that we could actually balance the budget without destroying the economy, without causing a worsening effect on the deficits that we have, then I think that you should probably, be nominated for part of this cabinet to help them figure it out, or the next cabinet. The voters, if you lower rates now, and remember, the politicians are on 4-year cycles. They don't care about anything but being reelected. We have that has been made abundantly clear in the last 3 or 4 administrations. They do not care about anything but being reelected. They will talk out of one side of their mouth and deal with the other side all day long. And it doesn't matter which side you're on, Republican, Democrat, I don't care. If you're in DC, you're likely in this game, and it's just overwhelming. Right? Well, and that's the question, is who's going to be favorable for the Fed. He wants zero interest rate policy. He wants liquidity. He wants somebody in that chair that's going to help facilitate that. We're going to see it. The question is when and how much. But Powell's done in May, right? So that it may take some more time to see that. If you see liquidity, front running the elections that are in November, you're not going to see the inflation off of that until months or years ahead.
Yep.
It takes a long time for that goat to get through the boa. It's not immediate. So, and that because you're talking about printing money, adding liquidity to the markets, adding liquidity that rises, that makes asset prices rise. And then the derivative of that is eventually consumer inflation. But that's a different thing than asset inflation. Dave talks about this a lot. And it takes a while for that to get through, that goat to get through the boa and be digested. And once it's in the boa, man, it is hard to stop, as we have seen. We saw when inflation sort of raged to 7, 8, 9% that they admitted to, that it's very difficult to stop that. And you've got to draw a lot of liquidity out, trillions of dollars out of the markets to stop that. It's not just raising rates. It's also that QT where you're literally drawing trillions of dollars out of the market to slow it down. So, but again, and that takes time to work its way through. So all of this stuff is on a timeline that markets understand generally. And if you want to see what's going on, please watch the debt markets. They have a finger on this pulse. It's not the equity markets. They are trading around it in real time, and they react to things very rapidly that often are emotional, and they're not what the long-term structural reality is.
Well, I mean, yes, that's absolutely true. Although if the equity markets you think react quickly, then the crypto markets react like,
Hyper.
you know,
They're hyper.
like Ricochet Rabbit, if for
Yeah.
those old enough to remember that cartoon, which probably most of our audience has no idea what that is, but you know, you can look it up on TV land or whatever. But you know, it is really really vexing to listen to, you know, this, just the assumption that curbing aggregate demand is what causes is about consumer inflation. Monetary inflation is very clear. I mean, you want to pull, you want assets to go down, you suck liquidity out, boom, you get 2022 assets go down. I mean, you know, pretty straightforward. That's pretty easy. But if you want assets to go up and you want consumer inflation to be muted, then what you need to do? Well, then you need to get rid of all the choke points. So what are the two biggest choke points on consumer inflation, and the two biggest levers they have? One, energy, by far the biggest, not even close. What's the other? Well, the other is supply chains of the stuff that people actually buy. Competition in supply chains not collapsing. What were the things that we were doing earlier this year on tariffs? You're not hearing a lot about it anymore, right? You know, the whole trade war with China. Why is that a big deal? Well, because most of the stuff we buy comes from there. You know, you want to drive the price of people's stuff up. Well, you tax it specifically via tariffs on what they're actually buying. Instead, you want to encourage domestic production. Well, you need to do two things. First, you have to make the regulations make it such that American companies aren't disadvantaged. That's really hard to do. A lot of it is state and local, and on the federal side, they're trying, but it's hard. What's the other thing you do? Well, you cut interest rates. Why? Because you want people to be able to invest in new factories and new things. But as you pointed out every time I mentioned this, James, months, years, you know, for that to actually impact supply chains.
Right.
And so, you know what you're trying to do. You understand that. And, you know, I just think the Black Friday data is fascinating, right? You know, you started this with this, Mike. You said real growth of 2% which, you know, when you saw that it was an all-time high, the nominal increase was significant. So effectively what your analysts are doing, if I'm not misquoting you, are saying there was real growth. So the consumers are still buying stuff. And that is different than we were hearing a few weeks ago. We were hearing a few weeks ago that wasn't going to be the case. It was all going to be inflation, but a significant amount of inflation in what people are buying. Did I catch that right? Is that what you were saying this morning in the morning meeting, Mike?
Yeah, so Anna, it was her, Anna Wong pointed out, yes, the nominal numbers are good, but the real numbers actually chalked down from last year from above 3% to a little bit less than 2% this year Black Friday sales.
Well, right. So, but let's get that right. It's not lower than last year in real terms. It's
still
less
up.
growth.
Oh yeah, so it's just less. Yeah, diminishing returns. Still up. Oh yeah, growth is positive. Yeah.
Right. So there is
yeah.
growth, and on a nominal basis, there's a lot of growth. And obviously, the administration would strongly prefer it to be, you know, not to be inflated, because when people have to pay more for stuff, I mean, effectively, I saw some analysts over the weekend talking about it, saying that, well, you know, Americans are trained to hold off on their purchases until Black Friday so they don't pay too much, because people and so a lot of what's happening is people effectively pulling backwards or forwards, depending on whether, you know, however you're looking at it, but they're trained to buy on Black Friday because that's going to save them money, because people don't have as much overall money. So that's why looking at Black Friday in a vacuum is kind of difficult. It's also important to understand whether it's necessities or, you know, or presents, or, you know, whatever people are buying. And I guess we'll get a lot more on that after Cyber Monday, which is, I guess, today. Yada yada yada. Right. You know, but it feels like, you know, James's you're getting away right when I was going to cue you up. I mean, you wrote about this weekend something, the game being rigged, and you know, I do a lot of spaces with you know, with people who talk about the K-shaped economy. That's become a very popular term. It's stuff we've been talking about forever. By the way, that is a large reason why people are in Bitcoin. And before, you know, you go through this, is that this one?
No, it's the monopoly one.
Yeah, it's a monopoly one. Yeah.
But
I mean,
Yeah,
I do want to do my weekly comparison. I'm presenting something, so if our background guy can see it. What I was talking about before. Every time, Mike, when you go through your charts, if you look at the far right of this, and this is getting worse by the week, the blue line is the Bitcoin hash rate, is the power of the network, and the black line is price. It continues to get the most extended ever, unless if you believe that that price is going to lead the hash rate down, which, by the way, is the narrative that happens at points in the halving cycle right before rallies, and you can see it at every other time. I mean, there's smaller moves, but you can see it around there. If you believe that you should value Bitcoin completely in a vacuum from the network itself, then fine. And basically you're saying, okay, it's an asset. I still think Bitcoin's an option, and we've talked about that many times. I don't want to go down that diatribe, but effectively, when you're looking at this is telling you the reason I don't agree with your 50,000 call, the reason I don't think we see these big drawdowns, are because this blue line. The blue line breaks down. That's a totally different situation.
So
I want that to be clear.
Let me follow up on that, because I love that chart. I used it for 5 years at least, every year, and I stopped using it last year when I flipped over to gold and risk-off assets. And because I thought sometimes we have to try to determine when the answers have changed. And to me, the answers have changed. Now we have a president who's a crypto billionaire, and a lot of the people got involved in the first place don't want to get involved, don't want to be exposed to that human being. They want to be away from the system. Gold allows that. Cryptos don't now. Now you're dependent on the cryptos. And we have a president who wants to run it hot, despite the fact that inflation is the #1 issue, and wants to get the Fed to ease, despite the fact that inflation is the #1 issue in elections. He's going to get unelected. I mean, sorry, this is the way things are working right now. But that's what shifted. And I fully expect now the signals I'm seeing from commodities are historic. We've never had gold rally at this velocity, with the stock market volatility this low, with crude oil going down this low. Never. It's never happened. So maybe it's just a feint, but I look at it as, okay, it's just predicting, no, we're going to have a down year in the stock market next year. Big deal. Not a big deal. If we drop 10%, everything changes. Bitcoin will probably go down at least at 50,000, maybe 10,000. I have that outlook. But here's a question I want to ask you. Is last year at this time, I was way early. I flipped over to completely gold and treasuries. Now, I think gold's so expensive, I should only be in treasuries, fully expecting that next year you have to be willing to fall behind when risk assets are taking off. But I see risk assets rolling over. And so critique that view, because last year you critiqued hard and overweight gold, and that seemed to work out. How about now?
Well, I think, first of all, risk assets is a really interesting definition. Arguably, everything other than treasuries is a risk asset, because you're looking to outperform it, because treasuries don't get you. You basically lose to inflation. Treasuries are a melting ice cube, to use Michael Saylor's stat. So by that definition, if you're talking about just search for yield or search for return, everything is a risk asset, including gold. Two things have changed with gold. Gold, first of all, gold and Bitcoin share one really important thing that people don't talk about. Yes, they're both provably scarce assets, although gold scarcity, kind of changes. There was some new gold discoveries over the weekend again, but whatever. I mean, it is what it is. They're both global assets, whereas U.S. Treasuries, yes, they are globally used, and less so over time, because people are sick of it. Right. And you've seen that in terms of central bank holdings of gold versus treasuries, but they're global assets. So it's not only what's happening in the US. And outside of the US, gold has found a product market fit as momentum hot money trading. And that is new. And that does matter, because I know we've talked about the contract for differences market, but gold and silver, I mean, silver, whoops, let me undo this. Let's kill that. Let's do this. Let's do this. Let's see if we can get it right. I mean, silver, is going crazy, and silver is a risk asset in the precious metals world, but it's now at record highs. And why is it being driven to record highs? Well, I can tell you that it's not physical silver demand in terms of coins in the United States. Dealers are, if you want to sell, you're selling below spot. There have been many times in the silver market when you want to sell, you're selling above spot, and when you want to buy, you would be paying a big premium. That is not the case now. The silver market is running because the hot ball of money that chases stuff is chasing it. And there are a lot of people who see silver as undervalued versus gold and, et cetera. But it really is, it does react with more volatility. And the volatility of silver is, what is it, 40% more than gold, Mike? Double? Somewhere between 40. Yeah, you're muted. Yeah, you're still muted. You have your mute button on.
Yeah, sorry. It's 2 times. It's the nickname's leverage gold.
Right, exactly.
Yeah.
So what you're seeing is there's a lot of moment. There's just a lot of leverage in the system, and a lot of people willing to employ it. And with contracts for differences, the gold and silver markets are no longer the stately market where you look at and you buy it, right before Diwali, when the Indians buy gold and use it basically as presents for their investments. And then you're done for the year. That market doesn't exist anymore. We've had central banks buying it. We know that, but we also have had this hot ball of money buying it. And that's my thesis of why I think gold will continue to move higher, because frankly, where else are you going to put it? The entire world is printing. Literally every single country now in the G7 is printing money. They're all running massive fiscal deficits. So if you do it in constant fiat, gold or silver probably will continue to go higher. Bitcoin has that narrative, but in the crypto community, who are the people who believe that most, there's been a lot of 4-year cycles talk, dumping, blah, blah, blah. And so that momentum isn't there. That momentum can switch on a dime. And all the people who keep making these leverage bets like this weekend, basically pushing it up to 92 from 86 last week, and now back down, round trip back to 86, are just trying to get ahead of itself and front run the next, quote, big move. Understand, Bitcoin volatility, despite it being up, is still, this is the other chart that's worth looking at. Hold on. Stop screen. Let me present this. Share screen. Bitcoin volatility index, right. So if you look, is this up here? Yeah, you can see it. If you look, you can see it at 1.93 is where it's at right down there. I don't know if you can see that. But this is where Bitcoin used to be in terms of volatility. So, and where it was, and you see where we are now. We are now in the middle, almost in the middle of the range, still not toward the high end by any means, middle to low end of the recent range, and still low by historical standards. And so what are you seeing with this? Well, you're seeing that it's, you would say it's a maturing asset. It's not at terminal velocity though. I mean, but it is still there. When Bitcoin moves, you'll see a spike, and it could be in either direction. The difference in Bitcoin and the S&P, I'll point out, is some of the biggest moves in the volatility have been on rallies. Whereas in the S&P, when the VIX goes up, if you told me the VIX was at 50, and where are we at now? 18, 19, Mike?
18.
Yeah. 18. VIX goes to 25. You're assuming probably a 3 or 4%, 5% correction. VIX goes to 30. You're going to assume a 10%. VIX goes to 40 or 50. You're assuming a 20% correction. Bitcoin, there is no such correlation like that. It's bidirectional. And so it's important to understand that we're still in a compressed volatility environment. What does that mean? That means that rallies get sold and crashes get bought. And it's generally in that. And there's reasons for it there, in terms of who's buying it. Most of the people buying Bitcoin are buying it for the same reason that people buy gold. The difference is there's no momentum in Bitcoin right now. Zero. You said it. It's down 10% over the year. You mentioned Trump. Let's be specific. If in the U.S. half the population says, "Well, I can't buy Bitcoin because that's going to enrich the Trump family," that's a very real thing. Now, investment managers don't work that way, but that is a real thing, and it does dampen. Things.
Dave, you can show the screen that I just shared.
I don't know how, but I'll stop.
There you go.
There we go.
So this is the 10-year. This is the 10-year yield. Okay, that's a U.S. 10-year Treasury yield. You can see what has happened here, and here's what where we differ, Mike. Is this how is it different this time? Well, it's different this time. It's not because it's different this time. What is structurally changed is the market, the world, the investors around the world are waking up to the fact that zero interest rate zero interest rate policy has put us in a spot where we absolutely must continue and we must continue to run deficits and print money to keep this whole charade going. So what Dave just said is gold has sniffed this out. Central banks around the world are buying gold. They're not buying U.S. treasuries like they were before. The demand for them is structurally down. Okay. One of the largest buyers in the world is Tether. Okay. That there's a reason for that. They're looking for pockets of liquidity with this thing. And so you've got pockets of liquidity for people who are on exchanges who can't just sit in dollars or can't just sit in a money market. That's the new money market. Okay. So that's what's happening there. But this red line shows that how we have broken. This is the structural descent of the yield on the US 10-year that ended in COVID. That descent ended in COVID, and it broke through, and it broke this long downward trend. And now the 10-year is at 4%. So when we say that we expect lower rates, we expect the Fed to lower rates on the short end. The Fed does not control this. We know that they don't control it because
they buy bonds when they want.
What's that?
I used to say the same thing, but now I've learned that when they want the bond yields to go down, they buy them.
Well, they can. The only way that they can the only way they can control this is through yield curve control. And the only way you can do yield curve control is by printing money. And the only way that you can print money is and the only way you can do that is by dumping. That means QE, dumping money into the markets, okay, which is inflationary. So this is not controlled by the Fed unless they print money. It's not by just lowering rates. If they lower rates like they did right before the election last year, okay, then they lowered rates by 50 basis points. And the 10-year went up 50 basis points. That's the reason for that is that investors realize, oh my God, they are going to just continue with this, and they're going to allow inflation to run hot. And even though it's nowhere near their 2% so-called target, they're going to allow some sort of range that they can stomach, whether that's 3 to 5%, which I believe that's what it is. Or they can just somehow manipulate it to look like it's not as bad as it really is. But you said it yourself, Mike. This is hurting individuals, not investors. It's hurting the everyday consumer, and they feel it. Whether or not the BLS will admit to it, whether or not the government will admit to it, the CPI, the PPI, whatever it is, the consumer feels it in their home and insurance and health insurance costs. They're feeling it everywhere.
Right. So one simple way that chart's going to go from 4 to 3% next year, which is my view, is the stock market going down 10% and staying down. Very simple fact. And you have to remember the key fact is the Trump administration is losing now. Inflation means they're not going to get reelected, which means we're going to get Democrats. The election's less than a year away. Inflation's the number one issue, and right now, if the elections now, they would get hammered. And then there's the Trump. That's what's changed. I'm just pointing out that chart there. I look at China, look at Japan. It's going to 2%, heading towards 2% in my view. And next year at this time, if we're heading higher, yeah, Mike McGlone, you're wrong. But
we're going to make. And my bet is that the U.S. Fed makes up the difference by adding liquidity from this side.
Just like in China.
Just like China.
Yep.
So
and their rates are 1.8%.
And that is what you're hearing from the gold market too.
Yeah, I don't disagree with that, but it's just so stretched.
You're hearing it from the bond market and the gold market. The bond market, that the chart I just showed tells you that the bond investors are saying inflation is going to rage, and they're going to let it rage, and they're going to do whatever they can to allow it. And that's what you're seeing in the
guaranteed not going to get elected. You just said the number one purpose of a politician, having sat on Republican town committees for 20 years, is to get reelected. If inflation runs hot, they're not going to be elected.
They wouldn't. I didn't say they wouldn't step in it. They have short-term views. That's it.
I mean, we have an election coming up, and Yeah.
This administration believes that if they can get the kind of liquidity in the market and they can spur investment, that they can run it hot and they can get it to the point where it's not hitting consumer inflation. That's what they want. I have no idea. I mean,
do you think, wait, just pause on that, Dave. Do you think, Mike, that handing out $2,000 tariff dividends would be inflationary or deflationary?
Well, we know the answer to that.
Okay,
It's all the Republicans push back on the stupidity of that.
We're literally talking about buying votes. That's what we're talking about.
I'm honored.
Yeah.
Whether you do it through illegal immigration, handing out Social Security and benefits, or you do it by handing out checks to everybody.
I think we should delve into this in a few weeks, when we get to the end, our New Year's predictions, but I think it's a little bit early to worrying about elections. The only thing we do know is that the administration is going to do what they can to run the economy and improve the job situation and make people feeling better. That's what they're going to try to do. And there's a bunch of levers that they can do, but they can't get anything done if Congress is totally dysfunctional. Because basically, and by the way, if in fact the midterms go the way Mike says, and I think that there's every reason to believe that it could, then for 2 years you're going to have nothing but impeachment out of Congress, and nothing's going to happen, right? So, which means we'll have total gridlock in Washington. By the way, markets
wait for risk assets. Yeah,
markets love gridlock.
Yeah,
markets love gridlock.
So I'm not saying that's going to happen. I hope it doesn't as a citizen, but markets love it. But anyway, we are way over time again. It's been fun. I mean, I miss Scott. Hopefully everything will go well with him this week, and we'll see.
We didn't even talk about MicroStrategy floating more stock to shore up their dividends.
Down 6% today.
MicroStrategy is what it is. I mean, they have enough cash to pay their dividends now for quite some time, and that's that. And
well, they listened to Wall Street, and they said, "You want us to have some cash? We'll have some cash." And now they do. They're going to have 2 years of dividends sitting there waiting to be paid.
Right. And so once you have that, then you ask yourself the question, when is the time? I don't know what the bottom of MicroStrategy versus Bitcoin is, but it's a hell of a lot closer to the bottom now. This might even be the Pico bottom now versus Bitcoin. If Bitcoin drops to 50, as Mike says, MicroStrategy is going to get cut in half again or more. If Bitcoin goes back to all-time highs, MicroStrategy is going to perform better than Bitcoin from here to there. It's just that's the math, and you can buy it or not.
If you believe Bitcoin is almost bottomed out and you want a little bit of extra juice, then MicroStrategy would likely be one of the names to hold. But again, you got to do your own research and understand these things.
That's
right. Understand how they work.
As I said, Bitcoin dropping 25-30% from here, MicroStrategy gets cut in half. I will say those words again so that we understand. While I think it's quote a buy, I think it is a buy relative to Bitcoin because it's trading at very low.
But to me, that's
and there's juice in the model.
That's a better trade than a leveraged perp. So
it's certainly, you're not getting liquidated, but you could afford to have a long-term view, just like Michael Saylor
could afford to have a long-term view. That's the point.
But understand what you're doing, because Mike McGlone is correct that if Bitcoin drops, MicroStrategy is going to drop more.
Absolutely. But if you're buying a levered Bitcoin ETF, you could get liquidated on a steep drawdown in Bitcoin too. It's just the way those things work.
That's right. Well, we're at it at 10:10, so we will sign off and we'll talk again. You guys both here next week?
Yep. Thanks, Jay.
Yep.
Thanks,
me
Dave.
too. Okay.
All right. See you guys.
Take care.
Cheers.
Let's go.